Hi, it's Dre Griggs, founder of Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. We are on our fourth week in our series of building income streams without losing sleep. Right, that is inspired and attributed to my wife, who my goal is to make more of my sleep than she can spend while she is awake. I tease, but not really, because she's going to be watching. So that's why I say I tease at the beginning. In this particular week, we're going to focus on the idea of building a side income. And this is not something that is just about having a side income in retirement. It could be. It could be something where we do it a little bit earlier in our career. And we'll talk about the benefits and how it helps us to leverage the multiple income streams. Hands down, the number one fear that people have in retirement, and probably in most ways, is our fear of running out of money, right? Outliving our money. And that fear might manifest itself with, I don't know if I have enough investments, right? I'm worried about the market going down and negatively impacting the money that I have. And that would impact negatively the income I would have. It could be if you have pensions or different conservative investments and the interest rates are down or your pension doesn't move with inflation, you're then sitting there like, I don't know if I can keep up with inflation. Well, that is just another branch of the same concern of, I don't know if I have enough money for this. And then when you're really thinking about in our younger parts of our career, we are normally making decisions because we're trying to get the money. We're like, oh, I really want to raise. And I'm like, oh, I think I have to be promoted. So I really want a promotion. And you're like, I don't know if the promotion is going to be like anything outside of the fact that it gives me more income. But what if we're able to kind of get certain ducks in a row with our income that then opens us up in a way where we can now work for fulfillment and joy, passion, and purpose, where we really are able to shift the idea of the meaning of money. Without getting too much in the economic weeds on you, there are two assets that we all have in this world, and it's time and money. That those are the two things that we trade. And earlier in our career, we trade a lot of our time for money because we don't have the skill sets to leverage just yet. And so we may trade our time going to college. We may trade our time working up from the mailroom up into a company. We may trade our time getting a certification or a skill. And we trade our time and then we increase our economic leverage to then demand more money. Ultimately, the idea of economics is I want to provide so much value in whatever it is I'm doing that they would happily give me their money, right? Because at the end of the day, when money is given to us, it's someone's way of basically saying thank you. Like, hey, I appreciate what you did. You've provided immense value to me. Now, if you work for 5, 10, 15, 20 years in an industry, how much wisdom do you have? Like, how much have you learned that makes you almost irreplaceable? From an economic perspective, there's three things that determine how much you and I get to demand from the market, right? So those three things are normally going to be how hard is it to replace me, right? How much the market wants what I do, and how good I am at what I do, right? So if you're the best neurosurgeon, then you're going to be able to command more money because we all want, if we need brain surgery, we want to go to the best. We don't want to play around with that. But in that there's a big gap between the best surgeon and the not best surgeon, right? So there's a big gap that we get to leverage. You and I might say, so if we picked, said, like a lawn service, is there a difference in the best lawn service and the worst? Of course there is. But is there a significant difference, right? They may miss a little bit over here. They may trim some trees not so well, but the vast difference between the best and the worst is not as large of a gap. And so we recognize this in economics where we make these trade-offs. When you're further into your career, you have built up so much wisdom that there's probably, and you can tell me if I'm wrong, but I've had many conversations, so I know that I'm not. They will almost try to talk you out of retirement, right? They'll be like, no, no, are you sure you're going to be bored? You don't just, kind of hang out a little bit with us. I mean, don't you just kind of want to be around, right? We hear these things where people are like, dude, I don't know what we're going to do when that person leaves. So maybe we could just get them to just kind of hang out, just kind of be around. I think that that's a beautiful time in our life to exert our leverage, especially if you love what you're doing. If you love what you're doing and you built a skill set in it, why not leverage it in a way where we were going to do it? Maybe you're going to do it for free in retirement, but maybe you can get paid to do it in retirement. And then if you're early in your career, the way I would think of it is if you've ever, and I have, so maybe you have too, have you ever been to a car shop, right? Been to a mechanic? That mechanic will normally have a shop outside of like that company. They'll have a garage that they work at, and they'll work on your car and different things. So I have it where my girls, they get their hair done, and we've had multiple times where the person who braids hair is like, yeah, I mean, I braid hair kind of on the side if that works better for you. Where we're able to leverage our skills in a side business, and it doesn't have to be a very stressful proposition. And so when you're talking about this, there's really a couple of advantages. Now, there's really more than two, but I'll give you two. One is when you're older in your career and you're talking about retiring, if we're able to trade our work in something where it's less stress, less demanding, and maybe the salary isn't that much, but we don't need that much. But if we're able to get our health benefits, I've seen that where it totally makes it worthwhile. If you enjoy relationships and just being around people, and your skill opens you up to being around people, having this engagement, this interaction, then you're totally okay with that. That you are going to do something like that anyways, more or less for free. And now you're able to do it in a positioning of yourself that allows you to be paid something. And so I'm someone who I really like the idea of flexibility and leverage. And if we have the wisdom that we just maximize it in the economy whenever it presents itself. And you see that early in the careers, people are like, yeah, I do stuff on the side. I will work on your car. Or, next time you want something, I can come and I can braid your kid's hair. Where everybody economically is like, yeah, I recognize that there is a gap between what maybe the market charges and what I personally could charge and live off of. And I've even seen, depending on your skill set, where you have like fractional C suites. And all it means is if I wanted to have literally the best of certain executives in certain industries, I might have to pay you $250,000 a year, right? Like, I'll pay you a lot because the value that someone would bring in the C suite is immense. Well, maybe I don't need you to work for a year, but I just need you to work for 3 months. I need you to come in here, clean it up, get us the right systems in place, set us up for success, and then you leave. And I will pay you your rate or higher. And I will do that. We'll pay you $75,000 for 3 months, right? And you'll be like, well, I don't want to pay $300,000 for the year, but I'm okay paying for a quarter. And you can find all of these opportunities. And so that's kind of what we're going to talk about today. Really, the way I want to think of it is as the side hustle, and it's going to be different for each of us. That it could be a passion project, it could be the wisdom and the skill sets we already have, or it could be something completely all new, all together that we just really been thinking about. And retirement doesn't have to equal no work. It can, right? Especially if you're stressed out and it's like burning you out. Totally, retirement can equal work. But I have found for a lot of people, retirement doesn't have to equal no work. That there are certain things that they like about work, and if they were able to get the right situation, then they would totally be okay with that. And we see people kind of all the time, right? And so when you look at it, retirement is less about stopping and more about choosing. And so when we have that experience, I got a little bit of a list of some simple low stress business ideas, right? So the easiest one that people always talk about is consulting or coaching. It's one of those things where if the goal is just to get out there, use your skill set, almost mentoring and leveraging, you could volunteer at a nonprofit. You could do that. You could also set up something to where you serve like underserved communities and you charge relatively a much lighter amount. You could work in a very official capacity where you're almost a consultant that goes into different HR companies where they're like, yeah, I ran HR for 20 years and I can do a handful of workshops every so often. And you get to decide how often that is. You could say, I'm going to do one a month. You could say, I'm only going to work for 3 months of the year and I'm going to take off the rest of them. You have the flexibility to decide. But I'm going to show you as we get through to kind of the end where the numbers and how they would work out for you, whether you're young and early or whether you're someone that's further into retirement or very close to retirement. I've seen people do like tutoring, online courses, teaching. You can have freelance work. So right, you can go on like Fiverr. You can do photography, crafts, wood carvings, writings. There is so much, and especially people trying to use Chat GPT for everything, right? Like if people trying to use, they really need a human touch, right? So even if they just reached out to you and had you edit their manuscript after Chat GPT wrote it, so you can clean it up for them, so it's not as messy. You can have, of course, you can have rentals, and the rentals could be equipment or it could be real estate. You could decide, and you can be long-term or short-term. You can rent out a room, like an Airbnb. You can do like Turbo. You can do eBay. There's so many ways that you can set this up. But the idea is if I'm able to generate anywhere from like $500 to $2,000, if you're early, that basically could be set aside to then leverage into the multiple streams of income. If you're later, that could be used to leverage where you work on some of the debt. It can keep you from having to take money out of your investment so that they last a little bit longer. And you can also, like I mentioned, have access to healthcare and obviously different communities and things like that. And there are a ton of tax benefits. I won't bore you with them all, but I think high level, we all know that business owners receive much more tax breaks than employees. I think high level, we know that. And so if you are now in a business, you can have a portion of your house written off as a home office. You got a portion of your car, you can have a portion of your laptops. You can have these different things that are part of your business that now go in business expenses. Heck, you could even go out to eat with friends. And then if you're able to set it up properly, you can have that as a part. I've seen some where they take trips and they get to write off parts of the trips, because when we're further in retirement, my kids are gone and we don't have as many deductions that are available, right? Like we may have paid off our student loans, so we can't write off that interest. Our house may be paid off, so we can't write off that interest, to where you don't have as many deductions further into retirement. And it might be one of those options for you where you have this side business income, you have some money that comes from that, and you're able to write off some of those expenses. And it's less about trying to trick Uncle Sam, where it's like, I took a trip to Hawaii and this is my business conference, right? I mean, you could, but it's more like, I'm going to meet a real estate agent. They're going to show me around some properties, and I'm looking at, as an agent, to look at properties that we could rent out. And you could do that. And you could go to the conference, right? It doesn't have to be that way either. But we recognize that there's lots of opportunities to write off some expenses, even if the business isn't generating like that much of an income. Just being able to write off some of those expenses where you don't have as much tax breaks, that helps you as well. Okay, so hopefully that works. So what we'll do then, and I will show you kind of a little bit of the idea. I'll show you a little bit of how the math would work, right? In the simplest world, and we'll try not to be too aggressive on the ideas, but in the simplest world, let's say, make the math easy for me. Let's say someone with a business income, right? So remember, there's really three streams or three asset classes. And we said those three asset classes end up being our business, real estate. Okay, I struggled there. And the stock market. And we get to decide which of those that we want to be in. And then that gives us the 7 streams of income. The idea, and what most of us do, is we end up with earned income, right? So that's one stream. And from there, we have to figure out, how do I leverage a certain amount of this in one of these 3? So today we're talking about the idea of having a side business. So we're going to focus on that one. If someone was able to start a business, right? So let's maybe say a couple $100 to get everything set up. If you were like the example I just gave, you're an HR and you help put together certain companies, you have certain documents, you can put together plans. If you just simply helped them set up their SOPs or standard operating procedures for someone with their HR experience, super hard for them. But for you who have been doing it for 25 years, not super hard. To where you set up the employee handbooks, you set up the training manuals, you make sure they're legally compliant, you check off all the boxes. Let's say that you generate, doing that, $1,000 a month. All right, so you do that every single month, then that would give you $12,000 a year. And now if we're later in retirement, that we might just be fine right there. Because if you add on your Social Security, which for most people, their Social Security on average is about $1,800, and I'm going to make my life a little bit easier, and so I'm just going to round it up to 2,000. So then on average, that's about $24,000 a year in Social Security. You have the 12,000 that you generate doing those manuals on the side, that puts you at 36K. The average person in retirement, it says that they spend around 50K. That's what the average person is spending in retirement. And so you're already at 36 and you haven't touched any of the investments that you probably had along the way in your 401k and different things, right? So you just might be like, look, I got this, like I'm okay. But if you're on the younger end, you're early on, you would continue doing this. So the idea is it depends on which income streams I want to then generate. So inside of my business, I'm already accessing. So inside my business, I'm already accessing profits. When you sell your business, that will open you up to capital gains, and you may not actually be interested in doing that, but we do receive that when you have an asset that you hold for a year and a day. It has to be a year and a day. Earlier than that, it's just no ordinary income, but a year and a day is considered capital gains, just a more favorable tax rate. You could say, and for a lot of people, real estate ends up being a bigger ask, and so we won't worry about that currently. But it is one of the streams that you could invest the money in. And then the other one would be the stock market. So inside the stock market is we can invest in dividends, which the official name of that is investment income. If you took your business and you created a program or so of some sort, or wrote a book about the processes you have, you could have royalties from the book, or you could just invest in companies that have royalty income that they generate, and you could do that as well. And then you have interest. And interest is what you and I pay all the time. We pay interest on our car notes. We pay interest on our mortgages. And so we're charged interest from banks. Banks pay us interest back. You also could give them CDs, different money market accounts. Those generally going to be paid back in interest. U.S. Treasury bills, they're going to pay you back interest as well. And then so you would take your $12,000 and then you would invest it in any of these asset classes. Or you could just you really should though. Really should. So for the sake of this, we'll say we'll put 12,000 over here, and now we'll say that we're going to stick on average of like 8% return. 8% return, and then we'll do it again. We'll have another 12,000 the second year, and then we'll add that in here as well, and we'll do that again. If you were buying dividends, rental income, which for the stock market that would be REITs, real estate investment trusts, then you would expect to have somewhere probably around like a 4 to 8% of income. So you have the appreciation of the stock, and then you have the income. So you're able to start seeing how that would double for you. Now, for some people, what they'll do, and I'm totally okay with that as well, you would grow the business. Maybe you have, so the easiest businesses that I've ever seen are service-based businesses where you just pay like a monthly amount, but it's not a lot. Like if you pressure wash people's houses, people will pay for that one-time fee. But if you mow someone's grass, they'll pay for that monthly fee. And it doesn't cost you a lot to get a lawnmower to get started. It doesn't cost them a lot. It just depends if you like being outside and things like that. But I would consider just adding one more person. Maybe you do it with your community. Maybe you have a friend and you're like, dude, I do this. Would you be interested in helping me put on these workshops? And you can. You don't have to. You can keep doing this on the side, or you can start building it up in a way that allows you to walk away from it. And without getting too crazy, normally what you'll do when you start investing in stocks is you will choose an allocation that makes the most sense for you. And there are literally hundreds of them, but I will show you a couple of stock allocations really quickly to where you don't have to worry about it. And you really could do this really with anybody. So what it's called is like you'd build a model portfolio, and we would determine what is the overall return that we're trying to get and how much risk we're trying to take. And so I will share it with you. This is from Vanguard's website. And so when you're looking at it, and they're like, hey, we have different asset classes. We have stocks, bonds, cash, real estate, commodities. That's normally going to be something with outside value, like gold has an outside value. It could be wheat. They have that as well. Oil also would count. All these it has a value in the stock trading it, but it also has a value in the real world, which is kind of nice. It gives you a little bit of extra protection that you would assume that even if oil prices went down, they wouldn't disappear because everyone's using oil. It's kind of like that. It's like it's a hedge against some of the risk, but they are very volatile because of the way that works. Like imagine if you were in commodities and you had oil, and then the United States said, hey, we're adding sanctions to Russian oil, like the two biggest Russian oil plants. That then causes all these countries to reevaluate how much the Russian oil costs with the sanctions and whether it makes sense for them to keep doing it. So China had put a pause on it, and India put a pause on it. They're the two number one and number two exporters of Russian oil. Well, if you're not following that stuff, you can see how that can get messy. So here, what we're saying is you have the greatest calendar year gain. That's what the green is, and then you have the greatest calendar year loss. That's what the yellow orange is, and then we have the average, and that's basically in the middle. I do like this because it's always important to remind us when I say average, or when anyone really says an average return, we're not actually saying like this is what you're going to get every year. We're saying that you might get 32% one year and you might get negative, you might lose 13% one year, that the average is 5. Now, granted, those large swings is generally not what's going to happen. But what we are saying is that there is a variance and it is a range. And I do like to remind people of that because if you were, and this is where a lot of people mess up with investing and the emotionalness of it, if you chose the stocks that had 32% last year, and you see that it's an average of 5%, that means the next year is more likely to be 32% again or less than that, right? It'd be less than that. It'd be much less than that. That's what it means to be the average. So it's almost like if you actually follow the trends, like you follow whatever the last cool thing was, then the probability of that actually going down in value is actually much higher than it would be if you invested in something that wasn't going down in value. And so we can see that we have 100% bonds. That's what's on this side. We can see we have 100% stocks. So we have the more risky on this side. We can see that it opens us up to be able to have the larger returns, right? More risk, but you'll see the variance increases, the range increases significantly. And this is, from 1926 to 2024, that you could have, on the worst year, would have lost 43% of your portfolio, or no, the best year would have gained 54%, and you would have averaged about a 10.5% return. And then for us, we decide what is the trade-off that we want. And for most of us, we would like it to be a tight range, that we don't want to have too high highs and too low lows, that ideally we want to be somewhere in a reasonable range. That's why you see a lot of people that talk about the 50-50 or the 60-40 or and things like that. Depending on our age is how we would end up deciding it. But you can see that, all right, well, the average return based on these portfolios, I could then decide what portfolio makes the most sense for me. And I will show you a handful of them. And then we'll move on and we'll be done. And the reason I like to show this to you is because it's the discipline that's required is what's the most important thing, right? It's not as much the investments, it's the discipline. We recognize that we have different economic seasons and different assets perform better in different seasons. So this is and I'll show you a couple of them. This is called the permanent portfolio. It's a very simple, I like it as the nice starter. It's a long-term stable option. So you just keep it this way and you're not really trying to hit home runs. You're going to hit singles and doubles. We recognize that we have 25% in large cap blend stocks. We have 25% in long-term bonds, 25% in treasury bills. That's short-term, right? So that's less than a year of government debt. Then they have 25% in gold. The way the thought of this is, well, I recognize that in times of economic prosperity and economic growth, stocks are going to perform very well. We normally have low interest rates. Businesses are growing. People are getting hired. They're spending money. So stocks perform well. I noticed that in a recession, stocks don't perform well. And so having your money sitting on the sideline in cash is actually a great position. You're basically waiting for the bottom to hit. And in cash, you're going to be getting paid a better return if you just leave it in cash because the interest rates probably went up because the Fed is trying to slow down the economy. And then when you have high inflation, that means your money is not worth anything. And if your money's not worth something, then gold is normally going to be a great holder of value. People can do anything. You can do real estate. You can do lots of things, but it's just something that holds my value. And then deflation, if your money is holding great value, then we would invest in long-term treasuries because that means that interest rates, I should be getting a high return because my money is so valuable. So I've already covered all 4 of the different economic climates. And then I should be able to just kind of sit through the market, recognizing that, yeah, every single day, a portion of my portfolio is not going to perform well, but every single day, another portion is going to perform well, right? And so there's different ones. You can go different levels. And so there is the all seasons. This one is like Ray Dalio's. I always give the caveat that so investing is about the information that we have. The information that you pay for allows you to be able to recognize opportunities easier. And that's why our Congress people do phenomenal, because they provide oversight. They have all the information. They're literally insider trading. And that if you and I can insider trade, we'd be crushing it. They insider trade, they do crush it. Ray Dalio shared a shell of his investment philosophy as a macro investor. Just means he looks at the world economy and he recognizes those patterns on the world stage. And he says that this ratio allows him to take advantage of a majority growing economies, which is where most economies are, but also hedging against some of those moments of short-term losses. And so he has 30% in large cap blended stocks, right? So large cap means about more than $10 billion. And then blends is normally going to be between growth and value. Growth means it's a company that we believe is going to do well and it's positioned to do well. Value means it's a company that's already doing well, and I'm trying to get it at a lower value than I believe the company's stock is worth, right? That's the difference between the two. 40% long-term bonds, you have 15% in intermediate bonds, and you have 75% in commodities, and then you have 75% in just gold. And so that's what this type of portfolio is. And then Ray Dalio, he runs Bridgewater Associates. He's closed that fund. He's made it all. And then the idea is, again, that I'm allowing myself the ability to perform well in a variety of different economic climates. That's all these different portfolios are made to do. And that is how you would ultimately make your decision. You look at things like your risk, you look at how you're feeling about things, if it keeps you up at night, and then you would decide the portfolio. The reason that we do this, and the reason this is important, is because at the end of the day, there's two things that are working, right? It's time and money. And so as you buy more of your time, then you have to leave your money to work. That the money is always going somewhere. So someone's always putting money to work. And the goal is for the money to work longer for you. And I remember listening to someone who gave, and it's so tough. But he's like, as you buy your time back, and so he was sharing what he does with his time. And he was like, I have someone who like washes my clothes for me. He's like, and that buys me back 2 hours a week. He's like, I have someone that drives for me. He's like, and then I could do my work while I'm doing that. And then that buys me back maybe like 10 hours a week. And he's like, I have a chef and a cleaner, someone who mows my grass. He's like, I don't fly like a private jet, but he was like, I have a charter jet where it's not just me, but maybe it's like 5 or 10 people, a smaller, right, private jet, charter jet. And he's like, so I pay maybe $1,500 a month for that. And it was like kind of all said and done. He was spending around $2,500 every single month, but it gave him so much of his time back that gave him the leverage to then use that time in a way that helped him to grow his company. And for me, it is true from the purest sense that if you pay someone $10 an hour to do something and you're worth more than $10 an hour, that's a good investment of your time. But at the same time, if you pay someone $10 an hour to do something and then you're going to lay and go to sleep, and then you can. But the idea of buying back your time is it gives you the ability to do some of the things that you want to do, whatever that looks like. It could be spending time with family, it could be spending more time traveling, it could be spending time writing a book, it could be learning a certain trade, it could be studying for something, going to college. All this stuff, you have to have the time to be able to do it. And so then you free up your time by trading all these things. And the system, in many ways, convinces us that money is the number one thing. And because of that, we end up trading all of our time for just a little bit of money because we were told money is the number one thing. And then somewhere along the way, I think we all recognize, I think I sold myself short, right? Like literally and figuratively, I think I've sold myself short. That I would love to have more of my time back, and even if it traded some of the money. And so I'm always talking about investing in these asset classes because that is how we separate our time from money. And so you can do it in a variety of ways. And then all these investments, they end up freeing your time, and then you use it how you would like. And so that could definitely work for someone. And if you're someone who's early on, and then you have a side business that basically pays your mortgage, I would imagine most people, if you don't have a mortgage payment, you'd have a lot more money that's left over. And then it gives you the ability to start just continuing to grow into leverage. And then as your money grows, then again, you buy more and more time, but now you're buying it with your money working and not you. And you just can kind of keep doing that and growing it. And I think of it as an economic game. It's a game that's fun, and I like to play it. And anyone else who enjoys playing it, then I would recommend that you do the same. So the last portfolio I will show you. All right, so this one's a little bit more layered, but I did want to just show you at least how I won't say complicated, but how elaborate, how detailed they could be. Because there are economic cycles, and then we just say, how many of them do we want to control for? Right? How many of them do we want to? And then, so this one is the 712s, and it was created. Who am I giving credit to? All right, so we're giving credit to Craig. So he has a PhD in financial planning. He has the 712s, and it says he wants to enhance performance and reduce risk by diversifying among a wide variety of assets. And there is the idea of diversification where if you diversify too much, it's true that you're removing the risk, but you're also removing the reward. Yeah. And so it's just finding that balance. But you can see that we have US stocks have large, mid, and small caps. So small caps would basically mean anything over 100 million would probably anything under 100 million is like a penny stock. So we're not talking about those, but anything over 100 million to maybe like 2 million is probably small, 2 million to 5 or 2 million to 9 is mid, and then everything 10 and over is large, right? So just so you know, non-US stocks, so we're going into developing and emerging countries, that definitely opens you up for exponential growth, but also opens you up for exponential loss. At the end of the day, it really depends on the way these countries' court systems are set up, where if corruption is the standard operating procedure, it's super hard to invest in a company because you don't have good information. And then a lot of these large firms that invest in those countries, they literally have people who live over there and they visit all the time and they get the information on the ground. Of course, real estate, there's only so much of it, so that one normally works. You have your resources, natural resources, and commodities, right? All the things we talked about. U.S. bonds, so right, that's just debt. A bond is debt. So with the U.S., and they have non-U.S. debt, so other countries' debt, and they have cash. So it just opens us up to having a little bit more exposure where we're hedging against different market activities, but there is some overlap. There's some things that correlate, and that means that they go in the same direction together. All right, and so that would be it, my friends. So the idea of a side business, right? So I have those. Yeah. Rental income, we checked over all of them, so we're good at that. And then for some, and it really does depend. But you could take, even when you have a side business, you do have the ability to open up your own personal retirement accounts. So that would be like a solo 401k or like a SEP IRA. It really depends on how soon you want to access the money, the age that you are in, all that. There's a lot of factors that go into that. What we are saying is if you're trying to reduce some taxes, that's an option that gives it to you. You have the side business, then you get to deduct that income and place it into those accounts. And then it's up to you. If you're like, I wouldn't have used it anyways, fine. You can leave it on and have the tax bill for the next generation. If you did want to be able to use it and access it, you could as well. But now you're able to have some tax deferred growth in your accounts as well. And so you don't have to, right? You don't have to take it all in, but we can be super creative on how we ultimately do things. And so from there, that's it, ladies and gentlemen. I do always appreciate the time that we have together. I hope you have a absolutely great rest of your day and a great weekend. Until next time, Dre Greg's founder of Obsidian Wisdom, where we help you to have more wisdom and less worry. Until next time, stay safe and enjoy